What if I told you that you could be a movie producer for as little as $100? Well, it's not a joke. There is a new movie in the works, which is the first feature film to be financed through tokenization, raising $1.4 million. So instead of big studios calling the shots, regular people like you and I can participate in its success. And it's not just the movies. In Abu Dhabi, there's skyscrapers worth $10 billion that are being tokenized, broken into digital shares that anyone can own. No more just watching or renting. You could be an investor in assets you love. Hello everyone, Dan Geltrude here, your host for Token Money Magnet, where we just don't talk about tokenization, we let you experience it, participate in it, and own a slice of our success. We're giving away 30 million tokens over 10 episodes of Token Money Magnet, and it's only for you. All right, today we're gonna debunk some myths about tokenization and explore how everyday people like you and me can invest in assets that were once exclusive to the ultra wealthy. Joining us today is Nitin Gaur, a digital finance powerhouse who's been transforming how Fortune 500 companies handle their assets. Also on the show with us today is Gord, a seasoned venture capitalist and serial entrepreneur who's transformed 4 startups into unicorns and backed over 80 game-changing companies. Michael, there's growing anticipation that tokenization could be the next major evolution in blockchain. Yet many investors still confuse cryptocurrency with real-world asset tokenization, even though they're very different. What are the major differences between the two? And please explain why understanding this distinction is so important for investors.
I guess you could consider some of the blue chips maybe real-world assets at this point, but the idea is that not all cryptocurrencies are representing a real-world asset, but any real-world asset, whether it's gold, silver, bonds, equities, private equities, public equities, all assets in general will find its way on-chain. But the difference is that not everything on-chain is a real-world asset, quote-unquote.
Difference between crypto and real-world asset tokenization. Crypto and real-world asset tokens sound similar, but there is a huge difference. Welcome to Token Money Magnet. Crypto versus real-world asset tokens. Let's break it down fast. Crypto, like Bitcoin, is pure digital money. RWA tokens represent real things like houses, gold, and art locked into blockchain. Think of it. Crypto equals digital money. RWA tokens equals real assets brought to the digital world by tokenization.
Nitin, some skeptics argue that real-world asset tokenization is just another hype cycle. Yet I hear some big companies are actively working on tokenization. So can you share with our viewers the reasons behind the rush towards tokenization, especially from some major institutions?
Yeah, great question, Dan. And I would say that, on the contrary, the entire industry, the entire financial services, industry, these are market structure providers, the custodian banks, the broker-dealer networks, the centralized security depositories, they all are figuring out as to what is their role in this new emerging technology that's enabling the asset tokenization. So as I think Michael touched upon this, where you have a real world asset, which is the asset that exists in our world, and what we're trying to do is tokenize them for transactional efficiency. And then you have the crypto assets or cryptocurrencies that are sort of powered by cryptoeconomic systems. From an RWA perspective, I'll just give you an example that, I have been working in my career, both at IBM and at State Street, working with some of the largest financial institutions. And today we are at a small point where about $17 billion worth of real world assets, so RWA for short, have been tokenized. And that's excluding the $220 billion worth of US dollars or stable coins of fiat. So this is essentially what we've done is we've tokenized cash as a fungible instrument, as medium of exchange And we have then begun to tokenize the stocks, the equities, the bonds, and all the other asset classes that Michael touched upon. And the idea being simple, that I want to be able to create a system that facilitates transactional efficiencies, that's inspired from some of the tenets of blockchain technology as transparency and immutability, and extending that trust systems, thereby reducing intermediaries. So I use the word reducing intermediaries. What that means is that all the various financial institutions that make up our market structure are essentially financial intermediary of some sort. I think it's evolving, and I've always said this, that things happen gradually till they happen suddenly. And we've been at this for over a decade. So I would imagine that this was just going to have a Cambrian explosion once we have the regulatory clarity, which we've seen that in this new administration and eventually around the globe. But we also see sort of a comfort level and sort of a familiarity with technology, and that'll fuel additional investment and an additional thought leadership from large and small financial institutions alike.
Coming back to you, Michael, we've heard about real estate and even movies being tokenized. What other assets can be tokenized, and how is it decided what could be tokenized? I mean, can I tokenize my car or my house?
Yeah, it's decentralized. So asking that question is like asking who's deciding what can be on the internet. Ultimately, you, based on whatever it is you want on the internet. The value of that content on the internet is based on the amount of people that you're providing a good or a service to. So putting your car on the internet, for example, is not necessarily adding much value to the market unless there's a way for someone to, for example, rent it on the internet, in which case you're providing, you're adding value to a small network. So yeah, all to say is that anything can be put on the blockchain, and investors will be able to, if they want to dive into the specifics, buy $100 of an asset, of a real estate asset, call it an apartment in New York, to trade for $100 of a villa in Norway. I think that there's going to be liquidity and granular liquidity in real estate markets like that. But yeah, everything is going to be on the blockchain: private equity, public equity, debt, all commodities, currencies, AI agents, entire businesses will be run on chain through DAOs. And the only limit to what can be on chain is what you think. Put whatever you want on chain.
So, Nitin, you've seen the effort needed for tokenization from a builder's perspective. Are there any examples where tokenization has significantly improved efficiency, reduced costs, or unlocked new opportunities for businesses?
Dan, I would say that a few areas. One is capital formation. This is essentially an avenue where smaller companies, the startups, essentially raise funds. And there's a whole process of socializing the idea and going after a bunch of VC communities, just like what Michael is doing now, trying to figure out where to invest. And we figured that when you look into capital formation, the hurdles are quite high, in spite of a lot of regulation like Jobs Act in the US and US around the world, is to lower the barriers to raise money for smaller companies and ideas to flourish and eventually become big businesses. I think capital formation in general, which is considered private markets, has become quite rampant. And we've seen this in early ICO days, except that it was marred with a lot of fraudulent sort of activities at a point. But I think it's coming back where we begin to see that you have not just on-chain transactions, which is essentially what Michael was touching upon, but these transactions facilitate movement of value. At the same time, you have the ability to get into things like voting for projects, and you progress projects from inception or ideation phase to investment phase. Second thing I would say that I've seen significant activity is around stablecoins. So stablecoin essentially is a tokenized version of your fiat, which is the currency that you hold in your wallet or in your bank account. And once you are able to move value, especially money, which is simple instrument that everybody understands, you're paying for things. You're paying for investments. You're paying for your, moving money across borders, which was the original use case for medium of exchange at that point. And I think what we've seen is, and this is astronomical numbers, that last year, stablecoin themselves represented about $13.7 trillion of transaction volume, which is much larger, and it surpassed the Visa's annual sort of transaction volume. So you see there's an uptake of the payment instrument. And again, we can dissect into cross-border payments and how much has saved the industry and the velocity of money that has increased because of the ability for them to move money. At the same time, the likes of PayPal, who've introduced their own stable coins, are drinking their own champagne. They're essentially, the venture arm is investing into the venture using stable coins. That's fueling the adoption of the technology in general. I think private markets, private credits, capital formation, stable coins are just the initial, I think, success factors that we've seen, and that has exponentially grown the last 2 years, I would say.
So Nitin, I want to just follow up with something here. In the past, we've seen how projects like FTX and Terraform have created a trust deficit towards cryptocurrency, but we know that that's not the whole story of blockchain technology. So when it comes to real-world asset tokenization, what safeguards are in place to protect everyone who wants to participate in tokenized assets?
Yeah, that's a great question, Dan. And I would say that for real-world aspects, especially for real-world assets, every asset class, so if you look at bonds and securities and real estate, we have something called micro-market structures. And this simply means that if you want to buy a house, you go to a real estate agent, and that goes to a whole entity which makes sure your registry is there. You have mortgage brokers. There's a whole ecosystem that facilitates buying and selling of a house. And then same thing for bonds and equities. You don't go to one financial house or a bank branch and say, I want to buy a house at the same time. But securities, these are different market structures that have evolved over time. And I think that with real world assets especially, that market structure needs to be preserved simply because there are legal frameworks, there are responsibilities, there's de-risking of financial systems. At that point, we're looking at tokenization of real world assets as purely a vehicle to increase transactional efficiency. And what that means is that you're lowering the cost of transactions. You're ensuring that it doesn't take 21 days to syndicate a loan or to be able to make sure your house closing when you buy a house. It takes about 3 weeks. It should happen almost instantly. So when you tokenize these things, you're introducing transparency, which leads to trust. And that's what we call it, the trust system as technology enables it. And by preserving the market structure, you're still preserving some of the risk absorption capabilities of these different actors and participants. And so that's how I see that you have these guardrails built in, that if it's an asset that is governed or regulated by some college of regulators, they will continue to govern them, and we're simply using technology to make its transfer and ownership more efficient.
Use cases and real-life examples of RWA tokenization. Real-world asset tokenization isn't just an idea, it's real life now. Welcome to Token Money Magnet. Real-world RWA tokenization examples coming up. Fractional property ownership, art investment for everyone, community business support, digital gold trading, green energy access, from property to art to gold. RWA tokenization is creating real opportunities, building communities and sparking innovation everywhere. See more real-life tokenization story. RWA tokenization, real life, real impact. Token Money Magnet.
So over to you, Michael. How do you see investment behavior changing for a common investor with tokenization who is currently limited to stocks, bonds, and real estate assets?
As all assets go on chain, all securities, all real estate, all bonds, it'll provide the everyday investor with the ability to have access to the international market, and then to be able to transact in the international market freely, without, for example, needing to spend tens of dollars to wire money currently from the US to China, or from the east to the west. There will be lower barriers to access international capital markets. And yeah, all kinds of new asset classes and new revenue models that'll be created as a result of digital assets.
Tokenization is transforming traditional industries, but you know what? It's not just industry leaders who are curious about this space. Our audience has a lot of great questions too. In fact, our panel has been monitoring various social media platforms and online forums to bring you the answers to some of the most frequently asked questions about real-world asset tokenization. So let's dive into what everyday investors really want to know. So let's start with this, Nitin. So how is buying real-world asset tokens different from buying whole or fractional shares of real estate as an investor?
So two things on this side. One is it's practically impossible for you to buy fractional unless you get into a specialized structure like special purpose vehicle as a legal structure that allows for syndication of investment coming into it. Of course, it requires a lot of paperwork. You need a massive amount of legal fees that goes into it. It'll take you 21 to 34 days to close into a house if you want to have multiple people claiming ownership. Besides that, I think it's almost practically impossible for you to sell a claim of your share in that syndicated process where you are selling your portion of the equity that's building over time. So you're making that asset or that investment illiquid. So it's time consuming, it's cost more in both in transaction costs, legal costs, as well as illiquid investment. Now let's fast forward to what happens when you tokenize these things. Well, the assumption is that we're not doing anything illegal, which means you still need to have a special purpose vehicle, again, a legal structure that has the responsibility in dealing with the likes of the local registries and the local regulation, and they are the ones who are sort of creating these tokens that provides investable interests into these real estate properties. Suddenly now you're reducing the cost because you have access to more liquid tokens. I can then buy tokens which will assert ownership into that underlying special purpose vehicle, which is a legal entity which provides the legality of my ownership into that asset. I can take a house and instead of waiting for 20 investors, I can chunk it up into 100 different tokens and price and value them accordingly. Third thing I can do is, because I have these tokens, I do have access to things like secondary markets. Suddenly now I can take these tokens and be able to go to appropriate secondary markets and exchange these tokens and thereby not only transfer value in a meaningful way from a legal perspective, but at the same time, we're able to provide a much more liquid instrument. And I can do all that with tokenized asset, which today it's a little bit more complex and much more expensive process, so to speak. And suddenly you can see as to how asset class after asset class, we are generating massive amount of liquidity, we're generating massive amount of market activities, which fuels economic activities. And that's essentially where we see the world heading into.
Great. So Michael, let's go to you. When the price of a token increases, does it affect the original value of the asset?
If we're referring to real world assets, then it reflects the perceived value of the asset, which sometimes the market is irrational on for whatever reason.
Yeah, we've certainly seen that. Nitin, what's your view on that as far as the token value rises, how that impacts the asset behind it?
No, that's a great question. I would say that, tokenomics increases the velocity, but doesn't change the economic principles, which is demand and supply driven price movement. And I always have said this both in my investment career as well as working with a large financial powerhouses, this price is what you pay, value is what you get. And so essentially, price of the underlying asset is driven by the demand and supply of the underlying asset. And of course, I think Michael alluded to this, that when you're getting into secondary markets, which is what token facilitate, then you have a little bit more of speculative charge to the valuation of underlying asset, which means suddenly now that you have velocity, and this is what every exchange does as you are building a dematerialized asset, which is what stocks and securities are. So to me, you can't. I don't think you can displace the underlying, economic principles of demand and supply. But I do think that there's a little bit of frenzy around token, which again is a speculative charge that these tokens, which at times does not reflect the underlying value, but it does reflect the market movement and market volatility.
Michael, how are the tokenized assets protected from damage or loss? For example, real property. What happens to the token value, and how are investors protected, if at all?
Technically, each contract for each piece of real estate could have arbitrary governance and economics baked in, similar to how any traditional asset purchase could have any safeguarding baked in.
What concerns would you have related to, and let's use real property as the example of, you have a situation where there is damage to the real property.
Yeah, so I think you're asking a very important question where there's a physicality of an asset and we are tokenizing that asset for purposes of transactional efficiency and creating secondary markets and liquidity. But the asset itself exists, which means that I mentioned earlier on that you need to have some legal structure, a caretaker of sorts, which is what commonly as a property manager or as a special purpose vehicle that is tasked with taking care of the property. But you still have to, by state regulation and regulation around the world, you have to obtain insurance that protects the financial interest in the property in the event of a peril or a damage from any of the insurable events. Now, of course, there's cost associated with all of this stuff. So the model that I think Michael was touching upon was quite simple. It's essentially you're doing two things. One is you are providing the property manager his fees, which hopefully is encapsulated into the token value. And all we're doing is we're creating a digital analog, if I can use that oxymoronic word, is I'm creating a digital analog of what would happen as a starting point. But yeah, I do have to deal with physicality of asset. I have to take care of it. I have to ensure that I'm dealing with it. And then you also have global macro situations where suddenly interest rates go up, there's inflation, your property value is affected. And that should be reflective in the ownership aspect, which is the tokens that you own and the value of that token. And hence the relationship between price and value is you may have paid a higher price in a down market, and suddenly now your property has lost value, and that should be reflective in the price of token that gets traded.
Well, I want to take this time right now to thank both of our guests for their incredible insight on this topic. And that wraps up today's episode of Token Money Magnet. We've learned how tokenization is making it possible for everyone to own a small piece of something big. I'm Dan Geltrude, and we'll see you in our next episode.